This episode of MoneyWeek Talks is brought to you by Lion Trust. Lion Trust is an investment manager that believes in the power of being actively different.
You know, fewer than 5 million British adults or fewer than 5% of British adults have a stocks and shares ISA. That tells me that basically 95% of British adults aren't knowingly or proactively thinking about investment.
Hello, I'm Kalpana Fitzpatrick, digital editor of MoneyWeek. Welcome to this episode of MoneyWeek Talks. MoneyWeek's motto is to make it, keep it, spend it. And in each episode, we will help you do just that with our top guests who come with incredible insight and views that will help you shape your finances. Whether you're looking for the latest trends, want to make sense of the markets, make more money, or just want to understand the world of investing better, then this is for you. In this episode, I have the pleasure of talking to Andrew Craig. I've known Andrew for some years and personally have also learned so much from him, and I know you will too. Andrew is a best-selling author of How to Own the World, Live on Less, Invest the Rest, and more recently, Our Future is Biotech. He is also an entrepreneur, founder of Plain English Finance, which helps people make better financial decisions. He's no stranger to the investment world, having started his career at SBC Warburg in the late 1990s, and he's held a number of senior equity roles at several investment banks. And today he's going to help us unravel the complexities of the market and what we should be considering when investing. Andrew, welcome and thank you for being here.
I'm delighted to be here. Thank you very much for having me.
I want to start with the word risk. Those that know and understand the world of investing understand that there's different levels of risk, and it's not always a bad thing because the more risk you take, the better the returns you can get. But if you're an investor in 2025, the chances are the word risk will come with a bit of a different meaning. We're living in a dangerous world, geopolitical tensions are endless. What should investors be thinking about when it comes to protecting your portfolio?
So I think if there's only sort of one panacea thought process around risk, it's all about time frame, right? And it's also about age and stage. So you can get into, if you want to be really technical and think like a trader, you know, risk and volatility and all those sorts of relationships, that's one thing. But our message is or my message is always all about the sort of fastest route from A to B, 80-20, of how does a sentient adult, particularly a British adult, make the most of their finances such that if they start putting something away in their pension and ideally as well their ISA from their kind of 20s, and they do that until they're in their late 50s or 60s, if they do that, they will have a life-changing result. And so if you are looking at it through the prism of long-term investment rather than shorter-term trading, there are actually some fairly simple things you can do to think about sort of how you have your mix of assets right and how you have them age appropriate in that sort of 30 or 40 year time frame that mean you really don't need to think about risk in the traditional way of, you know, equities are risky, or, you know, should I have a single stock or whatever else. Because if you're thinking in that really big picture holistic way of broadly investing for 30, 40 years, investing regularly each month and getting the mix of your assets right, then risk is naturally kind of ironed out of the whole equation anyway. And I guess the one just one addendum to that is, so how do you think about the right mix? And there's a lovely kind of rule of thumb, which I think originally comes from John Bogle, the founder of Vanguard, which is just 100 minus your age. And, you know, lots of people watching this will be familiar with that sort of thing. But basically, if you do the calculation 100 minus your age, that tells you roughly how much of what you're investing each month should be in riskier, higher risk, higher return assets, so effectively equities. And the balance is in defensive, lower risk stuff. And so basically, broadly, if you're 30, you should probably have about 70% of everything you're investing in higher risk stuff, because you've got all of those years left of your investing life before that necessarily becomes a concern. And if you're 70, you should probably have more like 70% of what you have, you know, in something defensive, in cash or bonds, or in my view, gold. So that rule of thumb just means that you don't have to think about risk the way a hedge fund manager thinks about risk, you know, as a private individual investing.
Move away from being essentially a trader. You're not a trader. We're everyday investors, right?
That's what the big thing I always talk about is the very key difference between investing and trading. And I think we live in an era where that's really poorly understood, and particularly by younger people, because there are all these influencers and crypto trading groups and everything else. And investing and trading are two completely different things. And it's really important to understand it. You know, investing is something you do for many, many years, regularly each month. You know, you have most people or almost anybody employed in this country will have an innate structure there, which is the pension. And anybody who wants to become a bit more expert and be more involved, and by virtue of that probably more likely to become wealthier, should also be thinking about stocks and shares ISA alongside that.
Of course,
but you know, I think one of the problems we have nowadays is that far too many people, and particularly young people, as I say, go straight past investing to trading, which is really hard and time consuming and quite an expert activity, regardless of what anybody says online when they're trying to sell you a trading course. You know, it is a very challenging thing to do. And the real tragedy is that statistically 80% of people lose money when they trade, but the worst bit of that is that they then don't ever do investing, because they conflate the two and they think they're the same thing. So, I lost loads of money trading and now I'm not even going to do pensions or stocks and shares ISAs, and that is a big problem in Britain at the moment.
Yeah. So going in too deep, basically, or just in the wrong direction, should I say?
Yeah.
So
complicating things unnecessarily.
Repeat that magic. I say magic formula. Yeah. What's the formula again? That you should be thinking about when you're considering how much risk you should be taking in your portfolio, and probably also just maybe cutting out the noise that could put a lot of investors.
Do you mean the 100 minus your age? Yeah, and you try and keep it
a magic formula.
Yeah, the magic formula, and it's not mine, right? You know, it's John Bogle's and others, and it's been around probably in the States. It's been around for a good 50 plus years. But if there is a panacea approach to investment, like one ring to rule them all, one idea to rule them all, I think for a retail investor, for your average person, that is a lovely, elegant way of thinking. Because I mean, if you sort of unpack why it's so helpful, because let's say you're 30 and you've got 100% of your money in the stock market, and there's a big stock market crash, like an 87 or a 99 or a global financial crisis, kind of 50% pullback. Now you've turned, let's say you had 10 grand. Now it's 5 grand. That's kind of annoying. It's a holiday, it's a deposit on a car, it's a whatever, but that is nothing as compared to the 60-year-old who might have spent their life building up to a pot of £1 million, let's say, if they're a reasonably highly paid professional, and if they're 100% in the stock market and there's a 50% correction, now they've got £500,000. Those are two very, very different scenarios. One of them's catastrophic and the other's mildly annoying, and that's why 100 minus your age just allows you, and you only have to think about it every 5 to 10 years. But if you do, as you go through life, it means you avoid that horrendous catastrophic problem. And let's not forget, an awful lot of 60-year-olds in the dot-com crash, and every time there's a stock market crash, there are a lot of people who are suboptimally positioned in terms of that risk assessment of equities versus cash or gold or bonds, and can really, really get horribly punished. I think that's a dreadful shame, because this is actually a really simple idea. Yeah,
so 100 minus your age, cut out the noise.
Yeah.
And have a goal. I'd always say have a goal as well, because it's good to know why you're investing, what's your end goal.
100%.
Because it's like you say, if you're 60 and that was going to count towards your retirement, and you put it all in stocks, then that's going to hurt.
And you panic.
It's going to hurt a lot.
And just for what it's worth, I mean, the biggest picture goal, the biggest purpose of investment ever since it was invented as a technology, capital markets, is to get to a point in your life where you can live on your capital, not your labour. Yeah. And so that, conventionally that is a pension. And it's a remark, I talk about this a lot, like the idea that pensions are boring. It's like a dinner party, cocktail party meme, isn't it? Pension's boring, accounting boring.
The word pension is a little bit boring.
Yeah, but what is a pension? I mean, a pension, for the first, it's like 99% of human beings in history worked until they died. Okay, like in mines or in an agricultural field, or think about it, right? In 1500 in some village, or in 1900 down a mine somewhere. And then we came up with the technology of capital markets, basically the stock market and the bond market. And then after that, we came up with the technology of pensions, and be able to delay, to take capital today and then have it pay you a yield and sustain you. And actually, that has meant that hundreds of millions of people in the last century have been able to play with their grandchildren and go on, football tours to somewhere else in the world and have several years of their life where they didn't have to work. And that, to me, that's actually probably one of the coolest inventions in history. But I don't think enough people think about it along those lines. Big picture, what have capital markets given us? Of
course, yeah. And opportunities. So we've spoken about risk, how you should be thinking about it, how you should be investing. if you're looking at the markets today, where would you see some of the key long-term opportunities in your opinion?
Well, so the first thing I want to just take a step back and say, I am all about, my crusade is that basically very, very few people are investing full stop. So the first thing, kind of Occam's razor or Pareto's principle, 80% rule is, fewer than 5 million British adults have or fewer than 5% of British adults have a stocks and shares ISA. That tells me that basically 95% of British adults aren't knowingly or proactively thinking about investment. So step one is to be investing, just park aware of the opportunities right now. And the way that there are sort of some very panacea, 2-century track record ways of doing that, which is broadly just, a big global equity index mixed with a bit of cash and bonds and gold in that 100 minus your age. And that will deliver a fabulous result, right? And I think that anybody in, say, their early 20s, when they finally have a bit of money, or their mid-20s or their late 20s, and they have a bit of money and they can invest, if they learn just that little bit, which is no harder than learning how to drive a car, in my opinion, and if they do that, and do that in their 20s and 30s, that, frankly, you can do that your whole life. The great Warren Buffett would tell you that's all you need to do. Yeah. And if you do that, you don't need to think in any more nuanced way about what are the opportunities. But my view is that, let's say you're 45 and you have done that and you've done 20 years of investing and you now have actually quite a big pot of money, because you will do if you do this. Even if you're on an average British wage, you will, which is one of the tragedies that so few people do this. But at that point, if you've got a little bit more time on your hands, you're interested in the subject matter, then you can start thinking a bit more nuanced and have some of your capital into, as you put it, opportunities, more interesting stuff. And for what it's worth, my own view, if you held a gun to my head and say, what's the view now, is probably the most exciting trade for the next 10, 15, 20 years, I think, is UK equities, truly. Okay. And I posted a piece yesterday saying something like, the UK economy is utterly screwed, which is why British shares are a massive buy. Yeah. But we can perhaps come back to that, because it's a valuation call and it's a markets discount economic recovery years before the economic recovery actually happens. So the best time to buy any stock market tends to be when that economy is in all sorts of trouble, because that's you're buying when there's blood in the streets, right? And that's Britain. And then the other one is biotech. Hence why I just spent 3 years writing a book about the biotech.
Can't wait to read this, by the way.
Thank you very much.
So it's interesting you say that, because in the past we have had people turning away, shunning the UK, but we've also had quite a bit of an exodus on the London Stock Exchange. So it kind of makes me think, are people not interested in the UK? And also when investors see these headlines, it doesn't sound very encouraging. It doesn't make you want to put money into UK capital markets. So what you're saying is actually the UK is where we should be looking, because let's face it, people aren't looking at US, but should we also be looking at the US still?
I get this all the time, and the pushback's like, why would I ever invest in British shares? British shares are rubbish. And there are so many things to say about that. I mean, firstly, through our own insanely incompetent and stupid policies, imposed, by the way, under Labour and the Tories, is not party political. So basically, for 30 plus years, the British political class and regulatory class have been doing everything in their power to destroy the London Stock Exchange. I mean, I don't want to bore on about that. I'm on record talking about that a lot at the moment, which is why we've lost half of our stock market listed companies. Yeah. A huge part of why that happened was around pensions regulation, which meant that anybody with a pension in the UK, 30-ish years ago, 50% of that was in British shares. And today it's 2%. And we're the only OECD economy in the world being that stupid. In Australia's 1.5% of global equity markets, and something like 40% of Australian pension assets are in Australian shares, right? In the States, it's like the US is 45% of global equity, 63% of US pension assets are in American shares. It's the same as South Korea and Japan and France and even Italy and Britain, the place that invented the stock market, is the only place in the world being as stupid as we have been. And so there's this huge chicken and egg thing that people don't understand, because what that has done is it's taken £1.5 trillion out of British shares in the last 30 years. Wow. And funnily enough, if you take £1.5 trillion out of an equity market, the performance isn't going to be very good, right?
No, right.
You're going to be, and also what that's meant is, because of all those outflows, there's momentum. So then every hedge fund in the world goes, well, there's clearly this, Britain's busy shooting itself in the foot, so let's all be shorting UK shares. There are loads of other reasons why UK shares have been structurally challenged. It's an old economy stock market and. So it's just been this, I described it the other day as, chaos theory. A butterfly flaps its wings and there's a massive typhoon on the other side of the world, this idea of chaos theory. And what Britain did, it started off with a trickle but became a flood, and it's destroyed the London Stock Exchange. Now, to me, that means that's the last 20 years, right? American shares have structurally outperformed the growth of tech. That's been goosed by just structural inflows into exchange-traded funds, the massive rise of passive, basically hundreds of billions of dollars of money goes into US S&P 500. That all goes into a market cap weighted ETF, which means that it disproportionately goes into the top 7 stocks. And we all know this stuff, right? But whenever you have the conventional wisdom, the majority of people telling you you're a complete idiot to suggest that British stocks might be interesting, and looking at the last 20 years, past performance is no guide. Whenever the world says, American stocks are brilliant, they're definitely going to outperform, because look at the last 20 years, and British stocks are rubbish, because look at the last 20 years, you know that 20 years from now, it will be 180 degrees the opposite. And you can actually already see signs of it, because the FTSE, not including AIM, but the FTSE all-share value index, I think I'm right in saying, has now outperformed the S&P over 5 years. So and the FTSE is obviously an all-time high as of when I came up here.
Right.
So this is beginning to happen, but now a trickle turned into a flood the other way. And of course, my own belief is we're going to, the British economy is horribly structurally challenged and will continue to be for some time to come. But this is one of the fallacies that a lot of talking heads get wrong, and a lot of retail investors get wrong, is there's very, very little relationship between Wall Street and Main Street. It's oh, there's a recession, that means the stock market's going to crash. No. And I always talk about this example. Look at COVID in March 2020, when we were basically living through, in real life, a horror show, a post-apocalyptic, people dying in hospitals, being locked down. If you'd asked the average person, is it a good time to invest in equities right now? What would they have said?
No.
99% of people literally would say, no way, you're crazy, people are dying in hospital. That year, 2020, 2021 were two of the biggest up years in the US stock market for a century, right? Not many people know that. And that's just and you can find illustrations of this throughout the whole history of capital markets. But basically, because there's such a lag, firstly, the world's incredibly complicated. Secondly, there's valuation, because if an economy's rubbish, but their stock market's super cheap, then their stock market might still be a buy, even though the economy's rubbish, which is Britain today, right? And thirdly, there's always a time lag between the real economy and the financial market economy.
Of course,
So there you go. That's why I love Britain.
I like that, and also, I agree as well. I feel like actually the UK is probably where you're probably going to find some bargains as well.
Yeah.
So take advantage, invest in the UK as well, and
just sorry to interrupt, but just crucially, only with a. I wouldn't advocate that everybody just puts 100% of the money in UK equities.
Never 100% anything, right?
Exactly.
So we've got to look after those eggs, to put it. I agree. I absolutely agree. And then actually, you're right. And there is this lemming attitude that investors have. If everyone else is doing it, you should be doing it. But I personally do believe it is the worst attitude to have. Don't copy the crowd. Which is
it's borne out by academic research, right? If an equity market is extremely expensive on whatever metric, then the likely returns of the next few years or decades is going to be structurally lower. And that's, every smart hedge fund manager in the world, or fund manager, or anybody commentator on markets is looking at the US equities right now and saying, it's the balance of probability based on 200 years of evidence is that the returns will be structurally lower from here. But I think the easiest way to play that, if you still want to just keep that Occam's razor, keep it really simple thing, is just to have the all-world index instead of the S&P, because then you'll capture the growth from wherever it comes. And obviously some UK. Yeah.
Another thing I know you're particularly passionate about is this whole debate around passive versus active investing. So John Bogle, we spoke about him earlier, founder of Vanguard and also godfather of index funds, once said, don't look for the needle in the haystack, just buy the haystack.
Yeah.
And the most recent data, as reported in MoneyWeek, based on Spot the Dog report from Best Invest, shows 137 active funds have consistently underperformed in the last 3 years. Andrew, what's your view? Should we be giving time and money to these misbehaving mutts, or is John Bogle's winning formula the only way to be successful when investing? Own the stock market through an index fund. I know what you're going to say, but let's say it.
Are you sure you do? So, first thing I'll say, this is an incredibly nuanced and complicated debate, right? And I think some very, very important things get missed. And without wanting to sound too hyperbolic, for the flourishing of our species, right? For the fundamental role played by capitalism, stock market capitalism. So So to try and unpack that, firstly, by the way, the other thing John Bogle said is that if the market became majority passive, there would be chaos and disaster and blah, 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 for kind of the reasons that I'm talking about. John Bogle reckoned that passive was always going to be a kind of monkey on the back of the effective functioning capitalism. We've gone way, way, way beyond that, and it's starting to create real problems. So to try and unpack that without being too verbose, let's think about why stock markets were invented, right? Going back a couple hundred years. They were invented to basically, for many, many, many individuals to be able to pool capital and therefore spread risk across a large number of individuals so we could do incredible things, like develop aeroplanes or build skyscrapers or send massive ships to the other side of the world, right? That is the most important function of a stock market, is to raise risk capital from large pools of people in order to do incredible things for humanity, develop drugs, all the stuff I've just said, right? We wouldn't have smartphones or AI or silicon or the internet or any of these things without stock market capitalism. What then developed was that those assets became available for, as I was saying earlier, for the pension industry. And that was another really cool sort of side effect of the technology of stock markets, is that now you fund all this growth and innovation, you can do things that humans couldn't do in 1500 or 1066, or you literally couldn't physically do. It was a technology, an enabling technology. And the other amazing thing is that you could look at the other side of the equation as an investor and say we can now invest in these things, which will throw off a yield and hopefully a capital growth and fund our retirement, right? And the trouble is that in the whole active versus passive debate, the passive zealots who are like, you'd be an idiot, exactly what you said, all active fund managers underperform, muppets, waste of time, expensive, is if you're focusing only on the returns to investors side of the equation, then that's a compelling argument. There are counter-arguments, but it's a compelling argument, right? But the problem with that is, which is a problem we are experiencing already today and all too seldom talked about, is, but then the growth and innovation bit of the equation stops working. And you have these laws of unintended consequences because you have trillions and trillions and trillions of dollars pouring into Tesla and Nvidia and these hugely goosed valuations. Meanwhile, nobody can IPO a company. Like literally, in London now, it's basically impossible to, 20 years ago I was on the desk at SBC Warburg and we floated EasyJet and lastminute.com and Campari and Burberry. And I think we did 28 IPOs in 1 year in 2000. I think I'm right in saying in 2004 there were 300 plus IPOs in London. Now there are 4 or 5. I can't remember what the number was last year.
I can't remember when we last spoke of one, but yeah.
But so London last year, the London IPO market raised less money than the Omani and Malaysian IPO markets, and a 20th of what India raised. Yeah. So imagine you'd gone in the 1960s to to the city of London and stood in the middle of Bank Junction and buttonholed a few passing, comedy blokes in their bowler hats and said, fast forward 50 years from now, London will be, there won't be any IPOs anymore. And London's raising a fraction of what India's raising and a fraction and less money than places like Oman and Malaysia. That's completely insane, right? And a huge part of the reason for that goes back to my earlier point about, British pension funds just coming completely out of British equities. But it's this structural rise of passive. And it's this idea that passive is right. That, that is hugely challenging to the growth and innovation part of the equation. And I think far too few people really understand, because so few people understand capitalism, and so few people understand equity markets. So they don't understand that, and this is not something that might happen in the future. This is here and now, right now. Our capitalism is super challenged. If you want to start a restaurant group or a new airline or any of the sorts of things that you could do 30 years ago in the London stock market, you simply can't. Right. And that's really important, regardless of whether, so anyway, so my view is that passive has its place, and I'm a big, I recommend passive ETFs all the time. But as you get older and wealthier and more sophisticated, it's almost like you should own active. And let's not forget, smaller companies, proper smaller companies, you basically can't put in an ETF. They're not liquid enough. They require, sub 300-400 million market cap companies, i.e. all the companies where the future companies will come from, future big companies will come from, those can't really go into an ETF. And so you need an active ecosystem to support those sorts of companies. And from 1955 until 3 years ago, active, the smallest 2% of the UK, of the London stock market, delivered more than 16% annualized returns. That's worth paying an active fund manager for, isn't it?
Right, okay. That's very long
interesting.
Answer, no. I get your argument, and I actually speak to, in the past few months even, I've spoken to quite a few active fund managers. I absolutely admire the work that they do and the insights that they have. and for investors, the access that they might give, like there's private companies out there that you are not going to get exposure to unless, you do approach an active manager. It's the patience I think investors lack. We know investing is the long term, right? But with active managers, I just quoted 3 years. It's not, I get that that's not a very long time period for an active manager. It's the lack of patience. Would you agree? It's like investors aren't patient enough. It's that
which
whole,
is a terrible
I'm not
shame.
making money.
But also, numbers and statistics and are extremely tricky and squiggly and squirmy, right? Because all the numbers you run from right now, we've just had a very strange exogenous period, an unusual period of history for equity capital markets where all the money's gone into S&P 500 ETFs from Zurich and Singapore, because basically when the US becomes such a huge weighting of equities, if you're sitting in London or Geneva or Zurich or Paris or Frankfurt or any global capital running money for clients, you have to join. You have to kind of join in the frenzy, right? Then you've got you've got billions and billions of massive hedge funds running algorithmic, momentum-driven algo strategies, right? So all of that S&P 500 ETF passive money goes into the S&P 500 and disproportionately into the Magnificent Seven. Everybody around the world goes, well, we have to be in that because otherwise we're going to underperform US equities. So then that's a huge bid for US equities. All the momentum-driven hedge funds come along behind, right? And so that's goosed it and goosed it and goosed it. And the S&P's given us blowout amazing numbers, right? So anybody looking at numbers now goes, well, the only game in town has been the S&P 500. And if you weren't long as hell the 7 mega cap tech stocks, you're rubbish and you're an underperformer. Like Ray Dalio, runs the biggest hedge fund in the world, like flat for however long, rubbish. What a waste of money. Why would you ever have your money with Ray Dalio? Except that's what's just happened in the last 10, 12, 15 years could just as well go into reverse for all the same structural reasons. Like it will be just as asymmetric to the downside as it's just been to the upside, quite possibly. Like we saw a little taster of it, with what happens after Liberation Day in April, right? And look, I'm not making a call, but I think there are compelling reasons to suggest that if those factors go into reverse, you'll be sitting there in 10 years' time and going, wow, look at how much active fund management has outperformed. Over the last 30 years, active fund managers have massively outperformed passive that's what so few people understand when they just stand up and go, oh, well, all this evidence is all these years. It's like, if you change the basis of the backward-looking calculation at some point, that all bets are off, and that's not true anymore. And I think very few passive zealots understand those two broad arguments about you're destroying growth and innovation by having passive to infinity. If everybody's passive, there's no growth and innovation. There's no mechanism for it. There's no mechanism for an IPO. How do you IPO if there are no active fund managers deciding whether or not to support a new company? And I think the numbers, it's like lies, damn lies and statistics. You can make statistics do anything, particularly at a certain moment in time. But it could all be very different, and the arguments will be very different in 10 years' time.
Different timescales, absolutely. However, is there an argument for someone, we haven't spoken much about, like sort of like people who don't invest, or we mentioned a little bit about people who don't invest. Is there an argument that passive ETFs are probably a good way for them to actually start because there's not much to think about. It's really easy.
100%. I mean, that's a big. So I like to feel that I'm not conflicted when I talk about this stuff because I've been a big advocate for. I think all 20-somethings should be putting whatever they can every month into largely, and the nuance I cover in my second book, Live on Less, Invest the Rest. It's okay. You do 100 minus your age, like let's say you're 25, you want to be 75% in equities broadly, and then your choice is then really to keep exactly that, keep it simple. You don't want to be thinking about like active UK small caps or biotech, you really shouldn't, not yet. You should be thinking about that when you're 45 and you've got a lot of money and you can divide it up into buckets. But then the only decision there is probably, should it be S&P 500 or MSCI World or Vanguard or FTSE All World, right? Which is 500 US stocks, 3,000-ish or 1,600, sorry, for the MSCI World, 1,600-ish global stocks in developed equities, or 3,500 in the ETF, 4,000 in the X, 3,500-ish in the ETF. All worlds where you get the smaller companies and you get India and you get China and you get Brazil and you get whatever. And to me, it's the rear view mirror thing and the keeping it simple thing. It's like, all I think people want to be doing with investment is getting a proxy on global growth. Human progress, global growth, population growth, scientific development, new industries, all of that. And all you need to do that is to have one of those three ETFs. Whether you get the American one or the global one, from the vantage point of 20 years from now, one of them will have done 9% annualized, one of them done 7.8% annualized. I can't tell you which one it's going to be. It depends whether there are any trillion-dollar companies coming out of Europe or wherever that you miss if you're in the US. So so they definitely have merit, but I think we are literally living through the death of the effective functioning of capitalism in the way that equity markets were really originally constituted, and these rabid passive zealots like, you must be only passive, active fund managers are all evil, and it's just so unhealthy for humanity, as hyperbolic as that sounds.
So if you're starting out quite young, passive is the way to get going. Once you've grown a bit of wealth, got a bit more money to play with, so to put it, think about putting a few more actives into your portfolio.
Yeah, but because
that makes sense.
Without wanting to interrupt, like there are periods of time over which active can deliver astonishing. Like I was in smaller companies at Swiss Bank and subsequently for years, right? And there are a handful of British fund managers in London who did mid-teens returns for many years, annualized, right? Now, because of what's happened to smaller companies in the last 5 years, I mean, happily, most of them retired at the top when they could look back at, I've just delivered 14% annualized for 11 years or whatever the stats are. People like Mike Prentice, who was originally at 3i and then BlackRock. I'm trying to think of others. Harry Nimmo at Standard Life. You know, there are various of these sort of fund managers who did do an astonishingly good job. And if you're in those funds, or Terry Smith, Fundsmith, you know, everyone's, oh, Terry Smith's underperforming, you know, rubbish. But it's like, but hang on, if you'd been investing in Fundsmith from when it was launched until right now, big picture looking back, you had years and years of like 19.5% annualized returns. Like, does somebody want to give the guy a break and be like, okay, so you've had a couple of bad years or whatever it is now, but in terms of actually over a long period of time, delivering an astonishing result for his shareholders, he must be so bruised and battered and fed up with all these people going, oh, Terry, you've been rubbish for 2 years. It's like, well, what about the previous 11 years or what? I can't remember how many it is.
This is it though. This is the investor mentality. We don't have patience, and we definitely
that's right.
do need
But that's
it.
why I think if you must see it as investing, not trading. You must see it as like basically, I think optimally 25 to 65. If you're lucky enough to do something that you're happy to do until you're, let's say, 65. So you've got 40 years, right? And in that time, there's some truisms, that big picture, asset allocation, stuff that's just really easy to learn and understand and get to grips with. You do that, and then I would say, not sooner than your mid-40s, when you'll have many tens of thousands of pounds, if not you'll have a six-figure sum if you've done that reasonably sensibly from your mid-20s to your mid-40s. You will, right? Across your pension and your stocks and shares ISA account. And then you can start getting fruity and going, oh, I think I might have an oncology ETF or a robotics. And they may or may not, you know, if you're lucky, they'll deliver 18% annualized returns for a decade of that journey. And if you're unlucky, they'll crater and halve. But, you know, you might as well have a bit of fun.
You don't know what you don't know.
Yeah. And the longer you do it, the higher probability is that you'll get supernormal returns from, e.g., biotech or mining and resources or something spicy and active. Right?
Yeah. Thank you, Andrew. As always, I always learn something from you. So thank you for your insights.
I'm not sure that's true, but I'm very flattered.
No, there's always someone to learn from every day, is what I believe. At the end of each episode, I like to ask the guests some fun questions.
Excellent.
So, are you ready?
Yeah.
Okay. If I was to give you £5,000 now, what would you do with it?
I would probably go and buy an absolutely fantastic pair of studio monitor speakers, basically for my home recording studio and for my ability to record my YouTube videos. So I categorically wouldn't invest it in anything, but if it was only £5,000. Or are you asking me, do I have to invest it in something?
You don't have to invest it. Okay. Of course you can spend it.
Well, I mean, I am investing. I'm investing in an awesome audio AV production suite in my home office, which I can then make YouTube videos and hopefully make back the £5,000 eventually in the fullness of time.
I like that.
Yeah.
You didn't say biotech, but...
No, well,
you didn't say biotech,
if it was £500,000, it would go straight into biotech. Yeah.
Great. Second question. Your life is about to become a movie. Who would play you?
Well, that's such a tricky question, because if you say like a really good-looking, glamorous actor, you just look like an egomaniac idiot.
No,
so I'll tell you what.
Say whoever you like.
And then now, having said that, if I say an actor who's not glamorous and good-looking, it'll be really offensive to them. But well, given that my surname's Craig, why not Daniel Craig? That'd be nice. Or somebody really amusing and talented, which is Simon Pegg.
Love that.
The comedian, who I think is great.
I can see Daniel Craig talking about biotech and investing. Can you?
I imagine he's quite a smart bloke.
I think he'd be quite good at it.
James Bond, I mean, you know, he's obviously had to combat loads of sort of biotech super weapons in his career as a spy.
Sounds fantastic. And finally, if you could make something petty into a law, what would it be?
Oh, I'm terrible. So many things. I mean, I sound terrible saying this. Sometimes when I just see somebody just throwing litter out of their car on a road, like on a high street or the freeway, I literally think I'll turn to my wife and go, death penalty. It's a little bit extreme. But I just think, so, anybody who just is happy to just chuck crap out of the window of their car into someone's residential street or on the motorway, whatever, I just think it's like, what? It's so easy to just collect it in your car and next time you go home, put it in the bin when you get, like, why would you ever do that? And I think there's far too much of that sort of behaviour going on in our society, and it's very selfish, and I can't stand people like that, but I think the death penalty is a bit extreme.
That might be a bit harsh. Sometimes it just, actually that reminds me, I
don't mean that, to be clear.
I remember walking home from school once and one of my friends, and it was definitely my friend, not me, by the way, who dropped something on the floor, and then a granny crossing the road sort of waved her stick at her and said, "You go and pick that up."
Pick it up, yeah.
Yeah, and I don't think she's ever littered since. I don't know because I don't see her anymore. But
I have had a similar experience where I've just sort of said to a bunch of teenagers, like, seriously? And they're like, well, I can't swear, can I? They're like,
No,
I won't say what they said to me, but it was colourful expletive.
Well, we like to keep it clean on Money Week in every way, including picking up litter, right?
Yeah, well said, that works very well.
No litter here. Oh, thank you so much. And I hope that was insightful for our listeners. And Andrew, just finally, how can people follow you?
So very easy. So Andrew Craig, spelt the same name as Daniel Craig, obviously, to my earlier comment. No, and it's plainenglishfinance.com is our website. And actually nowadays we started a YouTube channel about 18 months ago. It's growing really nicely. I'm really proud of it. There's loads of educational videos, like 12-minute videos that cover bite-sized topics. So please check out Plain English Finance and Andrew Craig on YouTube, and people should find it on there as well as a gateway into the rest of what we do.
Thank you very much. Thank you for listening.